Welcome back to the Mortgage Heroes Weekly Podcast Show. I'm Andy.
Yeah, I'm Brian.
I'm Will.
And I'm Lonesome Mike.
Yeah, Lonesome Mike. Good to have you on the show. Woo, Lonesome Mike. Okay, today, guys, we got the Fed pauses rate hikes for now. Will it last? Labor and inflation will help mortgage rates in 2024. U.S. home price insights September 2023. And homebuilder sentiment goes negative for the first time in 7 months thanks to higher mortgage rates. So right off the top, we got to talk about the Fed. They just came out with their decision. They decided to pause, but do you guys think that was the right decision or no? Was the pause the right choice?
I think how many reports until we see a trend? how many reports until we actually get a full reading of the data? I mean, they did say that they're halting the rise of rates, but then again did mention that they're going to be raising them up perhaps still. So it's like, what type of message are you trying to put out to the markets? Because as we know, as soon as that Jerome Powell said this is not our base case to do a soft landing, the market sold off. So
right,
here we go again.
And this is something I know I brought up in Monday Mortgage Minute too. It's like, well, if you know you're going to have room to make a rate hike later, like in the November meeting, well, then just make it now. But I think the hesitation is if they made that now and then it caused potentially more damage long term, they're also kind of leaning on that, creating a best case scenario for themselves to kind of wiggle into a solution that they can craft to tell everyone looks good.
I think it was just advantageous for them, but I'm with you. They should have just done that. Let's get it over and done with, and let's just keep moving forward. But I think the Fed, Mr. Uncle Powell, just wanted to say, hey, I just want to not raise the rate for the second time this year. I think that's what it was more. Yeah. More of a bragging right, maybe.
Well, and everyone and all the Fed members saying that they see that there's room for 2 more rate hikes kind of leaves us with the conclusion that, well, then there's one coming in November. So it's kind of like this catch-22. It's like, well, if there was enough room in the tank to go for 2 more rate hikes and then you didn't do it last meeting, you didn't do it this one, well, then, okay, you're signaling that we're going to have one in November, which, again, then that begs the question, why are we waiting longer than to just let that happen? Because even in the notes yesterday, they cite that they're going to see all these lagging indicators finally make their way through the economy and then make determinations based on data on what they need to do next.
Yeah. So one of the biggest things that I did read up in one of the articles was that the information for housing always lags. So that's still something that they're waiting for to be able to see. And hopefully by November, we get the numbers that we're looking for so that they either make a right decision and raise it up or, maybe a third consecutive halt, which, it's hard to tell because of the fact that inflation is still running up. We're still not near our, targets of 2%. And a lot of that has to do as well because housing and energy is not included in that.
Well, yeah, you're talking about core readings. Yeah. Core reading strips out the food and energy.
Yeah,
so
which is the most expensive.
Yeah, I mean, the overall shelter cost is a general problem when it comes to the inflation reading as a total, but specifically those things are lagging because they are, some things, like we've talked about before, are indirectly affected by the Fed's monetary decision. Some are directly affected. And those things that are indirectly affected take longer than those that are directly affected. So I think that's part of it. I wanted to read this part that they, from the statement itself is, in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which a monetary policy affects economic activity and inflation, and economic and financial developments. So that sounds like a lot of different things. They are, but they're also very similar, and there's a lot of things interwoven in between those things. So
Uncle Powell just stayed the course, like he said he was going to do in the last meeting, and so there he goes.
Yeah. We're going to continue to keep our eye on core inflation readings, which Brian was just talking about core right now. The pace at which new jobs are adding to the economy, and that is slowing. Job openings and unemployment are cooling a little bit. But again, we're still far off that target from that 4.5% they'd stated they wanted. And that was a public chart they shared earlier this year.
Yeah.
So we have yet to see that. And, I know, Mikey and I were talking about this the other day, like that 10-year yield is already flying and now surpassed what Mikey had taught us about 2 shows ago, which was this 4.3 kind of marker. I mean, and now it's trading past that.
Yeah, I think this was a nice move that they didn't raise the rates again. But like Brian said, because we haven't seen any trends, I think anything they put out right now, we just got to take it with a grain of salt.
Yeah, 100%.
Yeah, so inevitably what that means for the mortgage market, for all of you watching the show for the first time or learning about us for the first time, mortgage rates for the 30-year fixed loan and the 10-year yield do have a very strong correlation, even though they are not exactly tied. They do have a lot of historical correlation to one another. So when you see that 10-year yield go up past 4%, past 4.25%, up to maybe even 4.5%,
no bueno.
That is bad for mortgage rates. They continue to go up, which then now tips back into something we talked about before too, which is, are we going to see 8% rates? What do you guys think?
Yes,
I believe so.
Do you think we're going to see 8% this year? Okay, that's a yes across the board.
Yep.
Yes across the board.
Yeah,
okay.
most definitely.
I mean, we already saw the change yesterday alone. Yeah. Even though they said that they're not going to increase the rates, we already saw the change in it. The market didn't take it just took like a grain of salt, like Mikey just said. Nope, we don't care. Market's just going to still dip, and it's just everything else that Uncle Powell says.
Yeah. And I think that there might be some case to be made for people who are waiting or who are, let's say, in this conversation, but on the sidelines or on the fence of deciding what they're going to do in housing. Okay, now I know what's happening and I see it, even though we've kind of been seeing it along the way, but now they made this other pause and they're leaving only room in the tank for one more. Maybe that would be a case for someone to go, okay, cool, I'm going to find my entry point in 2024. I could see that happening.
I also heard an argument that says there's going to be a slight dip in November where it might bring a few buyers out to the market because of the fact that people that do need to really sell by the end of the year or basically just need to cash out on their equity. I think that we might be able to see a small spike in buyers towards the end of the year because of the fact that also whenever the Fed says that they're not raising rates or say about like them kind of holding rates, it does give the consumers mindset that, oh, maybe rates are going to come down. So therefore the following week, we might expect for applications to go up because of the fact that it didn't seem too negative if you're a consumer, but if you're an investor and you're in the markets, you know exactly what they mean.
Yeah, good point.
That's a great point. And I didn't tell you guys this, but I was actually having a conversation yesterday with my business attorney, and he was saying that this is a time of year when people who need to try to sell a business or close a business need to do it now because there's certain formalities that have to conclude before the calendar turns into the new year. Even if the business closes on January 1st, or let's say the first day open, which would be the 2nd or whatever, that technically is a new year, and that business is still open, which then it is required to do all the same things a business has to do in a new year. So even just by default standard, whether it's real estate or not, and in this case, if it is, then people who are looking to offload properties and it's in their LLC or whatever entity they have set up, that might be a time when they have to take that opportunity now to get the house in the market and try to sell it.
Ooh, so do you guys think we might see a lot of the Airbnb investors start to, put some houses on the market? I don't know, guys. What do you think?
Well, see, what's crazy is one of my realtor partners actually shared this information. Last year, in this year, currently we have like 3,000 homes for sale, but there's 8,000 Airbnbs just here in San Diego.
What?
Yeah. So,
where are they?
Wait, what?
Yeah, but they're not selling, right? So as soon as they start putting more restrictions and stuff like that, maybe we'll see a little bit more homes on the market.
Wow. Yeah, I know that Airbnb's actually been leaning into AI a little bit to help figure out what people are actually intending to use the rental reservation for, to try to curb partying and some other things. That's maybe for a different show, but I just saw that cross my desk this week, and I was like, okay, flag that one, come back to this and read about that later, because they actually employed somebody whose specific job is to help trim that down so that there's not so much that happening, because people are losing money and there's problems in communities and neighborhoods and damage to homes. So. All right. Well, the Fed did what the Fed did, guys. So one thing I just want, final thought on the Fed, it has to do with Lawrence Yun, who's the chief economist for NAR. He said the Federal Reserve is rightly on pause and is looking for more data before determining its next course on interest rates. So here's my question, Lawrence. I know we don't know each other, but I'd like to ask you this question. Will you agree with the Fed if and when they hike their rates in November as well? Because if you're saying the pause is okay now, are you going to say that the rate hike was appropriate in November too, or not? What do you guys think?
I think he's just trying to get some clickbait here.
I don't know that the chief economist for NAR is looking for clickbait, but okay.
No, I honestly feel like, if you think about it, he's from the National Association of Realtors, so his optimism is going to be like, hey, yeah, if they do bring down the rates, it's going to be good. If not, he's going to try to swing it in a way where I feel it's going to have a positive connotation to anybody that's listening.
Well, and he's taking a position here too, because he followed up with saying, like, with fewer job openings, slower job gains, and softening core consumer price inflation, the Fed must consider the potential economic damage arising from any future rate hikes. So he's kind of putting maybe a stick in the sand a little bit and going, I don't think you guys should. It's a little bit of a hint over there, like, hey, don't do it. But I'm curious to see if they do the rate hike, if he's also going to get behind that or not, or if he'll just criticize it.
And I mean, where's all my first time buyers at? How are you guys doing? How are you guys holding up? I feel like they're getting squeezed out. The mortgage rates are not helping them at all. And as you saw right here, they're the biggest ones that, come at a loss when the rates keep getting spiked up.
That's right.
Yeah. To Brian's point, if you're a buyer out there, you're an aspiring homeowner and you need help and you're trying to figure out where you fit in this entire conversation, drop a comment below. You can DM us or reach you guys directly, and we'll be able to help you out and get you qualified and see where you fit in this whole real estate game.
100%.
Okay, guys, changing gears, we're going to go to labor and inflation will help mortgage rates in 2024. That's a bold statement coming out the gate. Do you agree or disagree?
Well, if we're going off the fact that, unemployment claims went down, sure, but that was just for the week of September 2nd. So once again, I'm taking everything with a grain of salt. We haven't had enough data to show that. But sure, if you want to zoom in and base it off one fact, yeah.
Yeah, and this market's totally different. It used to be that when the traditional way was when inflation's going down, interest rates will actually go down with it. But nowadays, it's like you don't even understand what the data, because there's just so many other things that they're factoring in that we're kind of going in the opposite way.
Yeah.
Yeah, it's crazy you bring that up because, like, for me, seeing inflation go up and interest rates go up with it, I mean, that's just pretty normal to me. So to hear that in my head, like a light bulb went off, like, what? That happens?
Yeah.
Yeah, it is kind of defining this whole new normal we've talked about before, which like, are we supposed to be getting used to this? And more we talk about this and see these kinds of things. It's like, yeah, I guess we're being primed and conditioned that this is what we should expect and this is what we should be used to in the market. Whether it's comfortable or uncomfortable isn't the question anymore. It's whether you are going to agree or disagree. I agree that labor inflation will help mortgage rates, but because it will be painful. That's really the truth. It's going to be painful, and that pain in the economy is going to cause the Fed to have to start doing some sort of rate cuts in the future.
Absolutely.
So, do you guys think that a stronger economy leads to higher inflation?
Well, there's a part of that. It's 100% correlated, yes, because when there's more money in the system, that money can afford things at the price that they're set at. When there's less money in the system, it sounds like there's scarcity in the system, but it's actually scarcity of goods that can drive prices up, but volume of goods that can drive prices down.
No, 100%. And the reason I ask is because if we see on paper, we're all still making money. On paper, everything's still going up. So therefore, I feel like once we get that taken care of, I think the labor needs to soften up a lot more to be able to bring down the rates as well. And then that's going to help with inflation as well, bringing it down. So I think until we're able to see more softening in the labor market, because jobs are still being produced, people are still not claiming as much in unemployment, but at the same time, it is going up slowly, but not as fast as we'd like to see it. And therefore, I feel like rates are still going to.
Well, you got to remember, everything's with the ripple effect. Right now, we're probably seeing the rate hike that happened last year, barely. So we still have ways to go to see that ripple effect of what's truly going to happen.
Well, Will, if that's the case and they do raise rates again in November, could you see that carrying over all the way into next year then?
Absolutely.
100%.
Yeah, I mean, there's a delayed onset to a lot of this stuff. And what's a little crazy is when I zoom back on the chart and I look at the last 18, 24 months versus comparatively the prior 10 years, this is a very steep increase of the Fed funds rate over a very short period of time, historically speaking. Yeah. So to us, we've kind of been marching through it every 6 weeks to 8 weeks. They have their meeting and we go, okay, cool. They hike rates. Okay, but there's a point at which you have to go, okay, let's assess now what's happening because of that. And that takes time, to Memo's point. It could be 6 months, 8 months, 12 months. Certain sectors react faster. Again, to the point earlier in the show, some are directly affected by the Fed funds rate directly and some are indirectly, and those have different time onsets.
That's it. And everything's going to affect. Everything's tied into the economy. So it's going to affect one place and it's going to make another, jobless claims worse or more. Who knows? It's just confusing right now. Confusing times for sure.
Yeah.
And I think that's why Uncle Powell just doesn't know what to do. And that's why they're saying he's kind of like in a catch-22. Do I raise rates too high right now? Cause a possible recession, or do I just keep them and kind of see where we're at, engage next month or next Fed meeting where we're at?
Yeah. I mean, if you guys forgot, or I did not forget, I remember that, he used the word some pain many meetings ago. And he's like, we are going to be in for some pain as we go through this and determine what is the right rate policy or right monetary policy in order to affect the change in the outcome we need. And that kind of never left me. But yeah, I mean, admitting that there is some pain is one thing. And then admitting also that some pain is the lesser of two evils also suggests that they know something else could be worse for our economy, but isn't, because they're doing what they're doing now instead of that. So that's a little bit interesting.
Well, if Jerome Powell's watching this, we definitely are feeling some pain.
Yeah. Uncle Powell.
Oh, Uncle Powell. Sorry.
Uncle Powell. Yeah.
Uncle Powell.
And
please allow us to get into it.
And they know that this is they know what this is doing for housing. I mean, we get economic reports for housing every month, just as much as they do for jobs and for inflation and other things that measure. I mean, we get new building permits readings, we get existing home sale readings, we get new home sales readings, we get all the same stuff, and they get all that too. They see all that, and they, over a course of time, you chart where those things are making impacts, positive or negative, and then you have to make policy changes accordingly. But here's the thing: shelter being one of the most expensive cost components of people's lives, or the biggest in most everyone's cases,
of course,
it does create a problem. I think this is going to be an issue because housing is under a lot of duress as an industry, but that puts it onto the renter if they're renting or the homeowner if they're owning. stands, the people we refinanced at 3%, 2.5%, they're all fine. They're all good. Their job is the only thing they got to worry about. But
Yeah.
And they haven't been losing jobs right now.
Yeah, not at the rate that we need
not
to.
enough.
Yeah. And that's one of the things that I've been seeing with everything that comes out is that they're slowly conditioning us for what's happening next. So if you read between the lines, they're already telling us what's going to happen. We need to see more labor softening. Oh, what does that mean? More people need to get fired. Inflation needs to come down. What does that mean? More people need to get fired so they stop spending. So until we're able to control that, that's when we're going to start seeing actual facts when the Fed goes up to talk and say, hey, this can be expected, this can be expected. But as of right now, it's already like, I think this might happen. This might happen based off of this, but everything's based off of something. There's
I
no
like that
sureness.
word conditioning.
Yeah.
Yeah, I think there's going to be a loose correlation to jobless and the 10-year yield only because we are now at 10-year yield trading prices that are most recently seen in 2007. Here we go with a Wayback Machine reference to all the way 2007 is when we saw 10-year yield at this rate. And now we're going to start seeing jobless happen. It's a loose correlation. They're not directly correlated, but I think there is a case to be made where those do have some relative reflection on what's actually happening in the technicals. So there's that.
Yeah.
All right, guys, U.S.
crazy.
home prices insights, September 2023 through July 23 with forecasts through July 24. I know everyone that watches wants to know where house price is going. What do we think? What's the data saying? And what's our opinion? This is coming from CoreLogic, and CoreLogic's forecast is that our current year-over-year home price appreciation is 2.5%, and their forecast for next year is 3.5%. So, guys, where's the collapse?
Yeah. Again, this is nationally. Everyone's different.
Yeah.
Right. So if you're looking to purchase a home or anything, just make sure that you're looking in your community, in your area, so that you understand those numbers.
So where's the collapse, Mikey?
There isn't.
So interestingly, right here, it said 11 states saw home prices declines. All were in the West. But since many of those markets have inventory shortages, that trend may be short-lived. And I mean, we're seeing it here in San Diego.
Yeah.
Prices here in 9191. I mean, houses here in 91914, 91913 unexisting.
Yeah.
So I feel that therefore the prices are going to continue to go high, and home builders aren't building. So I mean, this is only going to go.
Yeah, Brian,
higher.
they actually even doubled down on it in the article. And they said, but as there's still an extreme inventory shortage in the Western U.S., home prices in some of those markets should see relatively more upward pressure.
Yep.
So they went in on it twice.
And, you guys know this just as well as I do, but every month I get my HomeBot report from you, and it tells me, and I look at the little graph, and it says for my specific neighborhood, the trough was actually June. So since June, it actually has recovered and gone back up on the chart, and it kind of hit that bottoming out, that local bottom out. But now that's 3 months behind me.
Yeah. I saw the same thing. It was like 1,034,000.
Yeah.
And now yesterday I saw it because I got my own, and it was like 1.2. Wow,
Yeah, just like that.
Yeah, so maybe I should just keep it longer. I don't know.
Yeah. Well,
Huddle.
the home price index is interesting because even when you go to that more granular level and you look at kind of segments of the country, whether it's, west, northwest, south, north, you get a little more specific and you drill in. It's positive. Like everywhere you look, there's regions that in general as a whole are still going back up, or not still, let me rephrase that. They had their little tiny pullback and now they are going back up once again.
Yeah.
And I think that this spells potential trouble when it comes to sales, only because you have mortgage rates increasing, prices holding steady on the high, and now you have people unwilling to sell, which all those things together means prices are where they're at.
Yeah. And here it is, guys. I mean, I love that we all have equity, especially if you're a homeowner. We're always purchasing a property to make sure that in the long run, we can provide this generational wealth and pass it down to our kids or what have you. The fact is that as appreciation continues to go up, there's going to become less affordability. And that's the problem right now. So as happy as I was, like, hey, my HomeBot said $1,034,000 in the beginning of the year, and now it's 1.2. It's also scary to see who can afford that.
Yeah. I mean, and especially at that rate, or not at the rate, but at that price, you're talking about a smaller and smaller pool of buyers. And, a couple shows ago, we talked about how it's harder for people in certain communities to break into those kind of higher cost communities. And at the same time, nationally, and again, this is a national stat, but you have what they call the entry level home evaporating and not available. And also whatever whatever entry level we want to call it now, by definition, is even more difficult to get from the price point perspective.
Yeah, exactly. So again, everything sounds good, but at the same time, how unfair is it to a first-time home buyer? How fun is it going to be for a millennial?
Yeah.
You know? Hopefully Bitcoin comes around, right? And,
and that's crazy.
Detour
because
of the day.
if we go back, like on paper, like I was saying, yeah, we are making money, but inflation's so damn high that it doesn't matter how much money you're making, it's still gonna get ate up by inflation and everything rising.
Absolutely.
So yeah, you're making over $100,000, but that $100,000 isn't the $100,000 that was 2, 3, 4, 5 years ago. So I think that also puts a strain on high earners as well. They're like, hey, well, I know I make more money, but it's also costing me a lot more, and I still have other stuff in life to take care of. So it's like you're really putting a constraint on spending.
No joke. On the way here to studio today, guys, I passed the gas station I pass every time I come to this way, and 91 octane was $6.57 per gallon. $6.57. And then the next gas station was the exact same price, and it's on the other block on the other side of the street. But there you go. For those of you using 91 in your car, $6.57 as of the recording of this show today. The final thought from me on this housing price topic was, they every month do this home price index top 10 metros change, and this month 4 of the top 10 actually had declines. You had Los Angeles, Las Vegas, Denver, and Phoenix, while the remainder were still in the positive. I think Miami was the surprising point, still had a 9% appreciation. I mean, that's not only top dollar, but that's some massive recovery. San Diego's kind of holding pretty at this 1.3%, a little bit less than their year-over-year current, and way less than the projection next year, but still in the positive. So I don't know what that means for you guys, but for me, that kind of stood out that we have 4 of the top 10 that went into negative territory, yet the actual increase is still positive and the projection is still positive.
Well,
Yeah.
I'm surprised we're making these reports a lot more often. I'm seeing San Diego come up on reports more and more now. It used to be San Francisco and Los Angeles, but now San Diego's getting thrown in the mix as well.
Yeah.
So,
Yep. And Phoenix is usually first in a lot of areas when it comes to this metric. I mean, I've been looking at this since 2020 on the monthly, and Phoenix was in the appreciation time frames. They were rapidly appreciating. I mean, at like 13%, 18%, 19% clip.
Wow.
But San Diego's right behind there in the second position. But now you have Phoenix dipping to this negative 4.2. I'm not inclined to say San Diego's going to see the same fate.
that's what I was going to say. I'm like, could we see that following trend coming over to San Diego?
So that's my curiosity. Like when they're going up, they're kind of going up in parallel, but San Diego's always in the number 2 spot. I don't know that San Diego's going to have that same dip for things we always talk about.
And San Diego takes it.
Memo makes this point all the time, and it's a great point, and you're new to the show, you're going to hear me say it before he said it a million times, is we're landlocked on one side because of the water, we're landlocked on the other because of the border, and we're landlocked to the north because we got Camp Pendleton. And you have a ton of military-owned land that we are not going to be able to ever build in. So there is a certain saturation and density here that just kind of comes with our actual territory, and Phoenix doesn't have some of those.
yeah, unless we have Dubai's money, we could actually build in the ocean, right? The way they do.
And then just watch it all wash away.
There you go.
Look, there goes a house. Hey, I guess you're probably not going to get insurance on that.
Well, maybe that'll be next.
I bet you could get marine insurance for your house if you build it on the water.
Yeah, that's a good one. Marine
Aqua
insurance.
insurance.
Yeah.
I may start looking into that.
I'm going to start opening an insurance company and call it Aqua Insurance.
Aqua insurance, yeah, for your houseboat. It's literally just a house on sand.
I see you guys came prepared with the dad jokes today.
Yeah, that's dad. You have a dad, don't you?
I think so.
Was that a joke?
All right. Okay, team. Homebuilder sentiment goes negative for the first time in 7 months thanks to higher mortgage rates. I mean, I was expecting this.
Well, I mean, can you blame them?
But okay, but here's the tale. Here's the tale of two stories here. You have the going negative, but for the first time in 7 months.
Yeah.
So in the last 7 months, haven't mortgage rates been higher than they were the year before and the 2 years before that? Yes. So what made them tip into being negative now? What do you think it is? How long they think it's going to last, or the current pain they're feeling now?
I just think it's a lot. It's going to be the uncertainty of what's happening, what's going to happen next, right? Especially with this new information with Uncle Powell, what he announces, the rates being where they're at. I mean, again, it's an affordability situation that we're in. How many people are going to be able to come into these new homes and have, 5 family members in here qualify for one home? So those are probably the things that we're going to start seeing more.
I think the builders are taking more in consideration that it's getting tougher and tougher on affordability. And although they could build and, have and hold and, give credits and whatnot, at what point does it just not make it profitable for them to build and have houses just, not be able to be bought because rates are continuing to go higher. Things are getting expensive. So people are now double thinking, should I buy the brand new house or possibly just take a different alternative route? And I think they're starting to see that in the last 7 months, that data was lagging. And now they're starting to see maybe holding costs are a little bit more more expensive. The materials are more expensive. They got to pay out workers. They got to pay out people that are basically at the new builds or finishing the projects that are still not completed. And now they're starting to see, like, towards the end of the year, damn, it's really not coming for force like we thought it was. And now we're seeing the numbers. I mean, it said right here, single family market fell 5 points in September to 45. And then anything below 50 is considered negative. So we're already been going down, down, down. Anything below 50 is bad. So where does that leave their sentiment?
Well, that's not the percentage wise, that's a pretty steep decline. Going from 50 to 45, representation is a 10% decline just month over month, at least in sentiment, if you will, in confidence. I do not like that they are saying they're feeling pessimistic because, for everyone who wants to argue, oh, sentiment doesn't matter. Oh, okay, well, it sounds like it does. So
of course it does.
Of course it does. Sentiment turns into building permits, just so you know. What's upstream from getting building permits? Your sentiments.
You see, when Jerome Powell goes up to speak, his sentiment has a lot of influence.
Building confidence is going to be an issue, but I'm going to go back to a story Mikey told us about his buyer who got how much was it? $35,000 incentive.
Yeah, $35,000.
And how much was the price on that?
$525.
$525 purchase price, $35,000 builder incentive. So then the question I'm left asking myself is, what was their operation cost? What was their build cost? How much is left at the end after they pay out their commissions? They do the incentive. Like, they have to be asking themselves, is all of this worth it to make $10,000 or $30,000? They have a revenue mark and target they're trying to reach, and I think that is coming under duress, and that's why they're feeling pessimistic.
Well, Andy, even when we had closed on our client, Brian went with me to the closing, and when we were there, we noticed they're still building a bunch of those townhomes. So, I mean, they got to be asking themselves and seeing the writing on the wall, how are we going to get people in these? Are we just building them just to build them, or what's going on?
I think inventory obviously is still going to be something, at least locally here in San Diego, the inventory is needed. That is not going to necessarily go away. Your people who can afford that might be diminishing a little bit right now in this current season of the rate situation we're in, but we definitely still will need the housing, because if it's not someone buying it for themselves, it's going to be someone else buying it and putting a tenant in there.
That's it.
Yeah. Even if it sounds like it's expensive, someone's going to do that for the long haul because, like, well, I'm just going to buy an investment then because I'm going to keep it here because there's demand in Chula Vista. Yeah. So I think that's always going to be a fallback.
Yeah.
Yeah.
Hopefully the rents work out. Yeah, those things are falling too.
Yeah. Well, you put 5 people in it. Like you said. Put 5 people in that house.
We are near the border,
Yeah.
So.
That has, okay, well, I guess that has something to do with it, but maybe not. Well, high mortgage rates is being blamed for some of this builder confidence, and then the consumer demand obviously is taking a hit from that as well. Rates and affordability. I mean, come on, guys. We keep talking about the same thing. It's like a carousel, but I also don't necessarily know what to do, because if you can't make builders build more homes, then that inventory has to come from the existing homes in the market, and that again now goes back to Brian's golden handcuff comments, where people have to be motivated to sell.
Yeah,
100%. And I think that we're yet to see more people sell their houses and get off those golden handcuffs, and we can expect that to happen once the market starts, the labor market starts softening a lot more. So we'll wait to see what happens with that, but I feel that's going to bring a lot more inventory down the line.
So much going on.
Yeah, there's a lot.
There's so many moving pieces.
Going back to that labor problem, I think that will cause some people to sell that have all this equity you're talking about, that they're sitting on that really low 2.5-3%. I mean, they might have to forego that in order to sell and just use that equity to pay off debt, or just to make it through whatever the storm they're facing. But
yeah, I mean, they're saying right now that we have historically the highest debt. Consumer on average has $77,000 worth of debt.
Wow,
that's a lot.
I didn't see that. That's a lot.
No,
that's a lot.
That's 100% salary right there.
And savings aren't stronger anymore either. Savings have been being depleted all year throughout the course of inflation rising up high. And I believe I saw in a report that many Americans will run out of money in October. So. Yeah,
we didn't, and even in this show, we didn't even bring up the whole student loan repayment thing. That's about to kick off in October too. So I think that's another ticking time bomb, if you will. I think there's more coming that we're gonna enjoy.
Watch
talking
out,
about.
DTIs. Watch out.
Debt to income ratio.
Watch out.
We should have like a funeral for debt to income ratios and all our files that are going to get blown up.
The good thing is that if you have the resources and you have the right team behind you, there is ways to help you allocate the right information so that you can make the right decisions and have the opportunity to still be able to buy. There's a lot of programs. We have a lot of knowledge here at our office. We have over 20 years of experience in the mortgage industry combined. So I really, really feel that right now, look for those lifelines that are going to give you the resources, the information, and the right tools so that you make the best financial decisions for your family.
Yeah, Brian, can I actually piggyback off of that?
No.
Well, okay. Let's say you're watching football or basketball, right? let's take LeBron James. Something happens in the game. He's not going to freak out and just sit there and be like, oh, well, something happened. I'm done playing, because he's a professional, right? Yeah. And if you made it this far in the video and you're still watching this, I know the market seems crazy right now, but we're the professionals and we're not freaking out. Yeah. So, I mean, if you still, have goals for real estate, it's still possible. And you'd be surprised how easy it is. Just connect with the professionals, please. Yeah. Let us guide you. Just let us guide you.
Yeah, good point. You have a lot of not only knowledge in the room, but experience, track record. And again, we're closing loans. So we have all these scenarios where people are getting into homes, new builds. I mean, you and I talked about one the other day, doing an FHA cash out refinance to pay off consumer debt, this consumer debt you're referring to. So in some cases, the need will precede the appetite, and the need will precede whether or not it even looks good on paper, but it has to be done in order to salvage the other thing that might be the top priority in your life.
There's no such thing as problems, only solutions.
That's it. Go.
Wow. Problems are obstacles.
This young guy,
obstacles.
This young guy's on the way.
Call him Lonesome Mike.
This young guy's on the way. All right, guys. What was the favorite part of the show for you, Mikey?
It was actually the ending right here. Just figuring out how to tie it into the actual consumer who's watching the show. And, like I said, even though things seem crazy right now, don't get discouraged, because once again, there's no problems, only solutions.
Yeah.
How about you, Brian?
I think for me is really getting to understand how to navigate the market, and all this information that you get put in front of you is exactly for that. So take it with not with a grain of salt, but just so that you understand what's happening, because this could be you in a certain position, or your family members could be in that position. So I would just say take very close caution to the information that's coming out. Know what's true, know what's BS, know what's just a headline that's trying to get you to get attention, but overall find a source that's going to give you information that fits your way of understanding.
Okay, good. How about you, Memo?
Yeah, mine is just knowing that the federal government, Uncle Powell, just said, hey, we're not going to increase rates now, but we're going to increase them later. It just gives us the opportunity to really prepare, plan, and just make sure that we're able to execute when the time comes when it's going to be needed. So
I am so glad you said that, because that actually dovetails perfectly what I was going to say today. Warren Buffett is famous for saying, be fearful when people are greedy, and be greedy when people are fearful. And I think this is the time where, even though things might look a certain way on paper, we talk about them and mechanically we understand what that means in a macro sense for the economy and people at large and homeowners and real estate. This is also the time that people will become fearful, and they will remove themselves from the market. And those who see the opportunity, like our friend Warren Buffett does, they're going to step in and take advantage of this market for the long term versus the short term. I think that's indicative by what we're seeing and what we're hearing people talk about. The fact that we still have people asking us to get qualified and buy homes and get into homes, and builders offering incentives to get people in homes. I am excited about the future. I am not fearful of it. And I am so glad that we were able to talk about all this stuff today with you guys. Thank you so much for our new show format and being here today. This was awesome. And thank you all for watching the Mortgage Heroes weekly podcast show. Yes. If you're watching this on YouTube, make sure you subscribe to the channel and turn on notifications so you get every episode when it's released. And if you're listening to us on Apple or Google, make sure you put on direct download so that every time we release an episode, you hear it first. Thanks for watching, and we'll see you again next week.
Peace.